Hi, I'm Matt Rowe, and I'm the Chief Investment Officer of Headwaters Volatility. We specialize in customized overlay strategies for institutional investors to change the shape of their risk. That can mean hedging downside, it can mean positioning upside, pretty much any way they want to tilt. So GameStop obviously was a big headline story in January and February of this year, and rightfully so, because we saw some pretty anomalous moves in the stock that weren't attributable to fundamental changes in the company. I think that's a really important thing to highlight right at the outset. It wasn't that GameStop was a misunderstood bit of brilliance in the market from a valuation standpoint. It was purely a liquidity event. And I think that's the important thing for us to highlight here. The short positions that were being held by hedge funds and other asset managers were largely part of a relative value strategy in aggregate, where hedge funds or asset managers would be looking to buy shares of companies that they think are undervalued, and then to bring their net exposure or their total exposure down, they're also hunting for attractive shorts to offset those. GameStop stuck out in a number of ways as being a good fundamental short, and because a lot of these hedge funds and a lot of these asset management firms are using similar, if not the same sorts of filters, it became a very popular short, and that's where the story starts. From a dealer perspective, if a retail investor or a hedge fund or anybody comes in to buy a call, they're effectively buying the stock from a risk standpoint. So when we talk about it from a risk standpoint, is it directionally the same thing? Buying a call is directionally the same thing as buying the stock. So if a customer buys a call from a derivative trading desk, the person that sold them the call is now short the stock. So to get neutral or to balance their risk, they need to go out and buy the underlying stock to pair against the call that they had just sold. And once they do those two trades, they have a directionally neutralized position with some other characteristics to it that are important to understand, but that's the way they neutralize their risk from a flow trading standpoint. There are a couple of different ways to define delta. Delta, as the term defines, is the sensitivity or participation rate of an option to its underlying security. So if we were to say that an at-the-money option has roughly a 50 delta, what that means in plain English is that the at-the-money, or where the strike is equal to the current price of the stock, the at-the-money option has a delta of 50, meaning that it's got a sensitivity to the underlying security of about 0.5. So if you move the stock up $1, the call should move up 50 cents, and vice versa. So that's one way of describing it. Another way to think about it is, what's the probability that that option is going to be in the money? It's a statistical way of trying to describe to whoever's reading the results, what are the odds that this option is actually going to be in the money when it gets to exercise, or it gets to expiration rather. So gamma comes up a lot whenever there's a big move in stock. People say, oh, well, dealer gamma is this, and the gamma profile is that. Really what it is, you can boil it down to the delta of the delta, or the change in the delta as you move the stock. So gamma is a curved line, not a straight line. So if delta were constant, it would be sort of a diagonal line. But because there is a change to it, there is a curve to it. So I wouldn't get too far into the weeds of what gamma is, other than understanding that it's exponential, that it feeds on itself, that it is curved, and as we talk about the impact on GameStop stock, it's important to understand, mainly conceptually, to understand that there's curvature to it, because now when we talk through the story of GameStop, it'll make more sense why this sort of fed on itself and snowballed. Whenever a market participant shorts a stock, they should be getting a locate, which means to go through your financial institution. If you decide you want to short a stock, whether it's just a directional play or part of a relative value trade, you need to get a locate on shorting the shares from the dealer of the shares. One way to short it is to get that locate and then go and sell those shares in the market, and you take the proceeds of the short and you hold them in the interim. Another way to create a short position, of course, is to just buy a put. So when the borrow gets more tight, or harder to get or more expensive to attain, volatility goes up in almost all cases because there's an arbitrage if it doesn't. And there's sort of a statistical balance or a derivative balance between the two. So you tend to see volatility rising in what we would refer to as put call parity, which is a fancy way of just talking about, a very simple formula where you're balancing calls and puts against each other. You start to see deviations there. So the story sort of tells itself in the derivative market from the early stages, and that's where things can get really out of control. And Volkswagen comes to mind prior to GameStop and a couple of other high-profile names, but the GameStop situation is unique in how bad the liquidity event was. Equities settle on a T+2 settlement cycle, which means that if somebody shorts the stock, the dealer has to post capital for risk of settlement in that T+2 window prior to settlement. And then the dealer needs to source the shares to deliver on the trade or make good on the proceeds. Either way, to consummate or settle the trade, it costs the dealer money in the interim. And one of the things that we're moving towards, we've gone from a T+5 settlement before I was in the business to a T+3 to T+2. We're now talking about, T+1 in near term. And Robinhood brought up in the wake of this whole GameStop situation their desire to have an instantaneous settlement, which would remove that dealer capital requirement, which was a big part of the story of why this got so out of hand. So what effectively happened is that a whole group of people coordinated through social media decided to try to tip over the market in GameStop, and they succeeded. And why I say tip over is because if you apply enough buying pressure to a heavily shorted stock like this, you can actually push the name through risk limits where you start forcing the people who are short to shut down their short position, which creates a buyer. And as that starts to trigger through and through and through, if you have enough money trying to push this trade, you can actually create that snowball effect. And that's exactly what happened. It really fed on itself. And the reason why it was a problem for the dealers is that they were having to post capital on trades during the settlement cycle that was larger than many of these clearing firms and custodians had seen ever. That's what led to a lot of them restricting trading and slowing down trading and shutting out some participants from the market. But the long story short of it is that we basically created a liquidity event and pushed through a lot of risk limits and forced a lot of people to be buyers. It wasn't, this is why I was saying at the outset, it's not a fundamental move. It had nothing to do with changes in the fundamentals of the business. It had everything to do with a liquidity event that was created by this forced buying. What does the change in implied volatility do to the market? A 5 implied volatility suggests a very narrow band of potential move of that underlying security. So let's just say, for example, if you have an 18 implied volatility for 40 calendar days, that means about a 5% move. If you double it, if you go from 18 to 36, you're gonna expand that to beyond a 10% move of implied one standard deviation implied move for the underlying. And so as that number gets bigger and bigger, the possibilities that are told through the derivative market get greater and greater and greater. So when you think about a lot of the risk programs that the underlying or that the dealers are using and that the hedge funds are using and asset managers are using, they use volatility as an input to understand their risk, not just as a characteristic of the positions that they have from other reasons. So all of a sudden it starts changing the way everybody views their risk when implied volatility rockets up the way that it did. So not only was there spot rate moves or underlying stock moves in GameStop that were moving up, but as implied volatility went up, everybody's playbook was telling them, hey, this thing could go up, it could triple in the next 6 weeks. You have to cover now. Even if your risk limits didn't tell you to cover before, now that this is flowing through to your system, you have to consider covering because the characteristics of the position have changed. So the story changes in 3 dimensions as this thing sort of starts to unfold. And you would think, in a fundamental situation, you would think that the long equity holders of the company would sell into this, and I think a lot of them did. But that's really the only reflex mechanism that's going to keep this story in check. And and there was no supply, no overwhelming supply of stock for sale on GameStop to keep this thing contained. The best way to play this would be if you were the CEO of GameStop and you somehow got comfortable with issuing shares when it spiked. The greatest beneficiary would have been GameStop. And I actually know firsthand that employees of GameStop were asked so many times about the situation that they put up signs in the store even and started telling people who were coming into the stores, no, I didn't just make a whole bunch of money on GameStop. I still make minimum wage or, things like that. So nobody at GameStop really benefited from this whole shakeout. And I think it's caused more drama than anything. Maybe they benefited a little bit from increased PR, but when you can't borrow shares, you can't short it. So you can't bet on the fall. And the alternative to shorting a stock would be buying puts. And when implied volatility gets that expensive, you can't really buy puts to put that trade on. So the heroic trade would have been to just sell puts when implied volatility went into the hundreds, and you were able to gather that premium and earn money as the situation deflated. But that's not without risk too. So it kind of got to a point where it was as we would say, it was radioactive. You just don't want to touch it. At some point you just don't want to be involved. And you add this onto a relatively long list of stories of why it is so hard to be good at shorting stocks, because not only do you have to get the fundamentals right, but the market is predisposed and geared towards having things rally and being comfortable and supportive of making constructive long investments. The environment and the ecosystem for betting against companies is still unstable, and it can be very challenging. So, being good at shorting stocks is very challenging for a lot of reasons. And what we would refer to as short alpha, or being able to add value in your investment thesis by identifying bad companies that are mispriced and shorting them and then watching the stock go down. It's a very valid part of the asset management world. It's also very, very tricky, and GameStop is a story that really illuminates all of the reasons why.